Well, after the Chancellor many times said that the coronavirus job retention scheme, the furlough scheme, would not be extended, what we've heard today is on the 1st of November, we've got 6 months of the job support scheme. It's very different to the coronavirus job retention scheme in that it's considerably less generous. So first of all, it's available to all SMEs. That will capture most small businesses, but not to large companies unless they can prove that they've been adversely affected by COVID. So look at the supermarkets, they've made tons of profits over this period. They're not going to be eligible for this scheme, but most other businesses probably will be. It's available to employees, or employees can be paid under this scheme if they were employed on the 23rd of September. But sadly, what that means is the employees needed to be on the August payroll, because you're only employed if you were part of an RTI upload before the 23rd of September, and for monthly employees that would only have happened if they were on the August payroll. So if you started your job after an August payroll was processed, you won't qualify for this scheme, sadly. Under the scheme, the employees have to work at least 1/3 of their normal hours and be paid at the normal rate for that work. They can work more, but 1/3 is the minimum. Of the shortfall, 2/3 of that is then paid, and the cost of meeting that 2/3 is split equally between the employer and HMRC. So HMRC is going to cover a proportion of the earnings, capped at £697.92 per month. Now, given at the very beginning of the furlough scheme, the payment was £2,500 per employee per month, plus the employer's NI, plus pension, we've got something that really is a shadow of the former scheme. What it does, the arithmetic is quite difficult. There's a worked example in our written update on this, so do have a look at that on our website. But it will achieve for employees, they'll be paid about 77% of their normal earnings, and of that payment, the government subsidy will meet about 29% of it. So there's still a big cost being met by employers. So it's good, it's been extended. It's not going to be generous enough to influence decisions of most businesses, but it's a nice to have scheme to have in place for the next 6 months. Well, whenever the Chancellor does something for employees, he's under pressure to do something similar for the self-employed. So we have the job support scheme for the employed. We have an extension of the self-employed income support scheme for the self-employed. Again, it's self-employed as in self-employed in their own name. It doesn't cover individuals operating through personal service companies, similar problem as we had under the old scheme. The extension is for 6 months, so the self-employed income support scheme is extended from the 1st of November to the 30th of April, and that's divided down into 2 3-month chunks. In the first 3 months, we're told that self-employed individuals will get 20% of their average profits paid out, but capped at £1,875 for the entire 3-month period. So again, just like the job support scheme, we've got something much less generous than what we were used to. The original self-employed income support scheme paid out £7,500 for the first 3 months, and then £6,570 for the second 3 months. So there's a big drop down to the £1,875 that we're now being told about now. And for the second 3 months of this extension, it could be an even lower sum. To qualify for this, you must have qualified under the previous scheme. So we've got all the same problems we had before. If you were newly self-employed, so your self-employment commenced after 5th of April 2019, you don't qualify. If you couldn't meet one of the average profit tests of having average profits of lower than £50,000, you also don't qualify. So an extension is welcome, but it's less generous than it was before, and all of the legacy problems of the old schemes are carried over into this one. Well, we've been having lots of conversations with our clients about what happens when all the tax that's been deferred over the last few months becomes payable, and some of it would be payable at the end of March, some of it payable at the end of January. I think the Chancellor has quite wisely foreseen that people aren't going to be able to afford to pay all the tax that they've deferred, so has introduced some more deferments on top of the deferment. So VAT, the VAT that was payable for the quarter March to June 2020 was deferred so that it didn't need to be paid until 31st of March 2021. But that's quite a big burden on businesses to effectively pay 2 quarters of VAT in 1 quarter. So what we have available to all businesses is the ability to spread that payment over 11 months. months. So instead of paying it all in one lump sum in 31st of March 2021, we've got 11 months to clear it down. It looks like you need to opt into that arrangement, but it's an automatic thing, so there's no need to prove hardship or anything like that. We also have the tax that was deferred for people who pay tax through the personal self-assessment tax return system, who would normally pay their tax in January and July each year. The July 2020 payment on account could have been deferred, and many people chose to not pay that July 2020 payment on account, and that would then have fallen due on 31st January 2021. What we've found out today is that in some circumstances, but not all, that payment can be spread over 12 months. So instead of paying it on 31st January 2021, it'll be paid over 12 months. Again, all interest-free. The devil is in the detail. When you get into the small print, that facility is only available where the tax due is £30,000 or less. So the deferred tax, we read that as being, if you owe more than £30,000, you've still got to pick up the phone and try and convince the revenue that you need further time to pay. So not as good as the VAT announcement, but still a welcome further deferment for some people. Well, a real lifeline to businesses was the ability to borrow from the banks with government guarantees standing behind the borrowing. So all of these schemes were due to end on the 30th of September, and what we found out today was that all of them, including the Future Fund, they've been extended to 30th of November. So we've got an extra couple of months to borrow money from the banks if need be. The CBILS scheme, so the Coronavirus Business Interruption Loan Scheme, the government guarantee has been extended to 10 years. So that's going to give banks who are lending under that scheme more flexibility to give longer loan terms, which hopefully are going to make these loans, which can be larger, make them on more affordable terms for businesses. The little brother to the CBILS loan, the bounce back loan scheme, what we've had introduced is a snappily titled pay as you grow element to that scheme. So again, the government guarantee has been extended to 10 years. That's going to give the banks, again, the ability to lend on longer terms, should reduce down the repayment profile. We also have under the pay as you grow system, the ability to go interest only. Now, a borrower can go interest only for up to 6 months, and they can do that 3 times in the life of the loan. So if they're falling on sort of medium hard times, they can go interest only to ease their cash flow. If they fall on really hard times, they can pause repayment, so actually take a complete payment holiday from repaying their bounce back loan, but this can only be done once in the lifetime of the bounce back loan. So the pay as you grow is just introducing extra elements. If there's any nervousness around borrowing because we're not sure what the future looks like, there's a little bit of leeway given here, probably for the good, as the bounce back loans have been really, really helpful to those businesses who couldn't borrow under CBILS. So good news. We'll see what comes next.